Go ahead and accept that. And what I want to do tonight is get us through chapter 2 and potentially into chapter 3. One thing that I am going to utilize from chapter 2 material that you probably are going to want to download is this cash to accrual to cash flashcard. When we get to that, and I think it's module 7 tonight, a fair number of students struggle with that. And I think the best way to deal with questions of that nature is to have a flashcard, memorize how to treat different problems. I'll show you how to apply the flashcard to a problem from our in-class material, and then also something from the homework itself in the Becker software. Okay, so that's where we're going. As I said, you probably want to download that flashcard, and maybe I'll give you a break at the time that we go through it so that you can go ahead and have a chance to take a look at that. Okay, so with that,
Professor, I was in mute before, sorry. For the previous videos, for the previous classes, I didn't find them.
Yeah.
I think just the one class I found them. Where
Yeah.
can I find them?
I haven't posted them yet.
Oh, okay. Okay, thank you.
Okay. Okay, good. So coming over and taking a look at module 3, which is to my recollection, is where we had left off, right? Last time, is that correct? Is everyone in agreement with that we left off on this fair value?
Yes.
Yeah. Okay.
Yes.
Okay, good. Thank you. So what's going on here? There are certain items in the financial reports that have to be carried at fair value. And what FASB did some time back was they came up with a framework to help a company determine, well, what is the appropriate fair value that should be, methods that should be used to determine the fair value for certain instruments. For example, say an investment in a marketable security. Okay, so that's where we're going, and they tell us that we can use this framework unless there is a particular standard that calls out a framework for a particular situation. And we don't need to really worry about when we don't use fair value. We don't use it in these particular instances because when we study that, they'll tell us exactly how to determine the value. So fair value defined is the price that would be received to sell an asset or transfer liability in an orderly transaction. Now, you say, well, what do we mean? What is orderly transaction? Well, an orderly transaction is one in which we don't have to have a fire sale. Think of it this way. You want to sell your house, and you're not selling your house because you got to get out from under a mortgage or the house is underwater or something like that. You're selling the house because you just want to get another place, and you can properly market the house, etc. Okay, that's a good way to think of that. So that's what we mean by orderly transaction between market participants in the principal or in the most advantageous market. Now, we're going to see that principal market is the market in which the greatest volume of transactions happen. Most advantageous is going to be the best price after we consider transaction costs, and we'll get into that here coming up on the next page. Okay, so we look to either the principal market, that's the one with the most activity. If there isn't a principal market, then we should use the most advantageous market. Okay, now again, when we talk about orderly transaction, we are talking about there's an ability to market activities and that are usually customary for whatever the transaction is. Okay, so it's not a forced transaction, it's not a fire sale. We have time to market, etc. Okay, now principal market. Okay, and let's just come down to principal market and principal market, and you can put down if no principal market, use most advantageous. If no principal market, use most advantageous. Okay, but the principal market is the market with the greatest volume or level of activity for the asset or liability. Okay, and then you come down and we say that most advantageous market. Most advantageous market is the market with the best price that maximizes selling price. Okay, after considering transaction costs. And note here, and this is a pretty important note, note that although transaction costs are used to determine the most advantageous market, transaction costs are not included in the fair value measurement. And we're going to look at the example in a minute. So flashcard that we would use the most advantageous market. And again, we only use the most advantageous market if there is no principal market. Okay, so what are the rules here? What are we going to apply? We're trying to determine fair value. We want to see what the market is for something. Orderly transaction. We'll look to see what is the most activity. If the problem says there is no market where there is the most activity, there is no principal market, then we use the most advantageous market after considering transaction price, but to determine what will carry that at for its fair value, we do not include the effect of the transaction cost. Okay, so let's just look at this example, and we have the security here in which there's a quoted price in New York, a quoted price in London. They tell us the transaction cost, and then they tell us what the price is net of transaction costs. Now, they tell us that if New York is the principal market, use New York. Very simple. If London is the principal market, very simple, use London. If there is no principal market, well, now we have to see what is the most advantageous after you consider the transaction costs. And it turns out what? London is the most advantageous, but notice we don't pick up the 48 there, excuse me, we pick up what? We pick up the 50, and that's what we use. Question. Okay, so pretty straightforward. Couple of additional things for non-financial assets. For example, if we're talking about some sort of equipment or something, then we would take into account the highest and best use, or by selling it in another participants that would use that asset in its highest and best use. So the key phrase there is what? Highest and best use. Highest and best use. You can go ahead and flashcard that. They tell us that a reporting entity's current usage of the non-financial asset is presumed to be its highest and best use. Okay. For liabilities, high and best use concepts are not relevant when measuring fair value of a financial asset or fair value of liabilities, because such items do not have alternative uses. And we've already talking about the principal market that we would use if we were talking about quoted prices, that sort of thing. Okay, so they've told us that we use what? That we use the highest, you know, the market with the most activity, or the most advantageous market to measure fair value. But where do we get those numbers that we're looking at, right? Is it from quoted price for that asset, say an investment or something? What are we looking at? Okay, so US GAAP has a framework that will allow us to determine what inputs we should use in determining that number, that 52, whatever it was. Okay, now we have different approaches. One is the market approach. Market approach says, hey, if you were to go ahead and try and sell this thing in the open market, what would you be able to get for it? That's the market approach. Okay, go ahead and flashcard that. You come down, income approach says, well, what kind of income can you generate off of this asset? Maybe that will be the way to determine the market value, the numbers that you use to determine fair value. Okay, we'd have to discount those future cash flows on that. Okay, And then the cost approach is, well, what if we had to replace this item? What would it cost us to replace it? Okay, so these are different approaches, and they start talking about inputs that you can use. So now we're starting to get into what numbers will actually be relevant to this decision. So when we look at the hierarchy of inputs, we have 3 levels, and they go in level of best to least reliable that you sort of use, you know, if all else fails. Okay, so level 1 inputs are pretty easy. Level 1 input said, well, what is the quoted price of the identical asset? You hold a stock in Apple, you need to carry that at fair value. So you look, you say, well, what was Apple trading at on December 31st? You have the identical asset. Okay, level 2 inputs would say, well, maybe there are similar assets out there that aren't identical, but they are very similar, and I can use that. Okay, now, when I look at those two, the level 1, the level 2 inputs, and you should flashcard what these level 1, level 2 inputs are all about, identical or, okay, thanks a lot. Just put a flashcard around those things. Watch it not let me do it again. Okay, now it lets me do it. No, it took away my highlighting. But if we're talking about level 1, level 2, identical or similar, that's probably most relevant to what? To the market approach, right? Hey, I hold an asset in that exact kind of stock, or I have a stock that's very similar. I'm thinking that's probably most of the time what we would be looking at, level 1, level 2 inputs for the market approach. Okay, now when we look at level 3 inputs, and level 3 inputs are the last resort. So when you look at this, first you look to level 1, you don't have a level 1, you look to see if you have a level 2. And if you don't, then you look to level 3. And these are unobservable inputs for the asset or liability. Unobservable inputs reflect the reporting entity's assumption and should not be based on, excuse me, on the best available information. And I think the most important thing about level 3 is it's the last resort. You only use them if you can't find something that would be at a level 1, level 2. So it literally is a hierarchy. Okay, now let's take a look at some disclosures, and I'm going to have you flashcard this. Typically, guys, I want you to flashcard disclosure discussion, because at the end of the day, disclosure discussions are pretty much, what do I have to disclose? You just need to know that. You might as well commit that to flashcard. So quantitative information about unobservable inputs, obviously you're using level 3. Discussion of sensitivity of level 3, information about non-financial assets and liabilities, and how they may differ from their higher and best use, and the hierarchy for items that are not measured on the balance sheet but are disclosed in the notes to the financial statements. Sometimes they just ask us for fair value disclosure. Okay, good. Flashcard that. And I don't know, they give us this example here, and I don't know that it's particularly necessary for what we're talking about here, but at least it gives you a sense of maybe what the process would be. So during the year, they purchased 3,000 shares of Mileage Inc.'s common stock. At the time the purchase of the stock was trading at $24 per share. The quoted price for the stock. So we got a level 1 input, don't we? Okay, so they ask us to calculate the fair value of the stock at the end of the year. We bought it for what? For 24. We, you know, now we're measuring it, since we're using the level 1, the identical asset, and we now see it's being quoted at 2150. So it's now worth 64,500. And we would record a loss. We would write that item down. And we're going to get into in chapter 4 how to account for investment in stock and account for the losses, and how we'll run that through our fair value through net income determination. That's all in chapter 4. We'll get to that. Okay. Okay, good. There are some exceptions for fair value. Okay, when you wouldn't have to use it, if it's not practical, Fair value cannot be determined or fair value cannot be measured with sufficient reliability. Go ahead and flashcard the exceptions. I can see maybe saying under what circumstances would you not use fair value measurement, and that would be a good flashcard for that. Okay, good. With all that, let's go ahead and let's take a look at our first multiple choice question for the evening. Okay, good. Let's go ahead and looks like most of us had a chance to try this one. So I'm going to go ahead and end the poll, assuming I can move this up where I need it. It's not going to let me. So I'm just going to do it here then. Okay. And looks like maybe having to do this ambidextrous thing all night, it looks like, but it looks like most of us got this right. The answer here is C. We know that we should use the principal market, but if there is no principal market, okay, which was the case for this one, you use the most advantageous. Most advantageous is what? New York, after you consider transaction costs, but then you don't quote it net of transaction costs. You do what? You go ahead and you go to whatever it was before the transaction cost, which was the 103. Question. Okay, good. Fair value, fairly light. Segment reporting, another fairly light area. Now I've got to figure out how I'm going to clear that content. Hang on, guys. I think that's it's little green spot is a little annoying here. Let me see if I can clear that. Okay. I think I got it. Okay, good. No, it's still there. Maybe if I hit erase, I can erase it. Okay, there we go. Okay, good. Okay, so let's go ahead and let's take a look at segment reporting and what goes on with segment reporting. When we're looking at this, we're sitting here and saying entities are these giant consolidated reporting entities. But when a corporate manager, sorry, I can sit here all day, my phone won't ring, won't do anything, and then as soon as I get into class, here it goes like a fireworks show. Anyway, more information that you need to know about. Okay, so when we talk about our segment reporting, what we're saying here is that companies consolidate their financial statements. We'll get more into that in chapter 4, but that's not how the company's managed. The company's managed by what? By division, by segment, etc. And so corporate managers have information on their desk that they use to manage the company that the FASB looked at some years ago and said, well, you should disclose some of that information. You should provide footnote information about segments. And so, you know, the company said, well, gee, do we have to disclose everything that's on our desk? And FASB says, no, just the big stuff. Okay, so what's going to happen? 2 important takeaways. The information that we provide for segment reporting is information that is already readily available, that the entity uses to manage the company, but it's not everything. Second point, it's not everything. It's what? The big stuff. And we're going to see that there are some thresholds that we will use to determine if something is significant enough, big enough to be included in the financial statements, okay, or to be included in the disclosures of the financial statements. So the objective of segment reporting is to provide information that will help users of the financial statements, right? We talked about that back in, chapter 1, that we're focusing on users. Now, the required disclosures is for public entities. Why don't you go ahead and flashcard that? We're talking about requirements for public entities here, and we are talking about information about operating segments. Okay, it could be geographic areas, etc. Okay, how does the company manage? Now, the accounting principles use the same as the main financial statements. It's not like all of a sudden, just because we're providing segment reporting, we're going to flip over to cash basis accounting. Use full accrual accounting, use the same standards. If you use LIFO inventory method for your consolidated statements, you should use it for your segment reporting, okay? Intercompany transactions are not eliminated. We want to show what a particular segment would look like if it was a standalone entity. So if there are intercompany transactions, we do not eliminate those for this segment information that public companies are going to be disclosing, okay? As I've already had you flashcard up there again, or you can flashcard down here if you want, it's up to you. It applies to public companies only. It does not apply to not-for-profit or non-public companies. So maybe you flashcard that, since it also says who it doesn't relate to, and you don't have to flashcard it up there. There's no sense in having 2 flashcards on that. Make sure you know that it's public entities and not-for-profit, and obviously not non-public if it's public companies only. Okay, now what do we mean by operating segments? And I think the most important thing here that I want you to flashcard is the definition of a segment depends on how management defines a segment. So it's how does the senior management look at the company when they're making various business decisions. And the idea of FASB was, okay, well, provide not everything, but some of that information to the public, okay, in the disclosure for public companies. Now, corporate headquarters is not a segment. So even though they may be looking at corporate headquarters and making various business decisions based on looking at corporate headquarters as a responsibility center or whatever, when they're making their business decisions, they are not going to have to disclose that. They don't have to disclose information about pension plans here. Now, there are, of course, requirements for pension accounting, which, by the way, was removed from the CPA exam last year, so we won't have to worry about accounting for pensions anymore for the CPA exam. Okay, Now, when we look at a segment and whether or not we have to report it, okay, we are going to look for what? The big stuff. So it's how does management look at the company when they're making their business decisions, et cetera? Is it everything? No, it's the big stuff. Well, how do we know if something is big enough that it needs to be reported? Okay, so when we look, we have 3 tests, and all of them are a 10% size test. Okay, so it's 3 tests. All of them are 10% size test. Flashcard that the 10% size test is applied to revenue, reported profit or loss, assets. Now, they only have to meet the 10% test for one of these. So if they don't meet it for revenue, then we would go to profit or loss. If they don't meet it for profit or loss, then we'd go to assets. So they don't have to pass all 3. Any one, and you check it. You check a segment for each of these to see if it's large enough that it would have to be reported as a segment. So what do? Revenue. We take all the revenue of all the segments, add them together, and we do not eliminate intercompany transactions. We multiply that by 10%, and any segment that has revenue that is greater than or equal to that 10% number should be reported as a segment. If it doesn't meet the test for revenue, let's go to assets. We take all of the assets of all of the segments, add them together, multiply that big combined number by 10%. We don't eliminate intercompany assets or anything. Multiply that number by 10%. Any segment that has assets that are greater than or equal to that 10% number has passed the threshold and would be reported as a segment in the footnotes for our public companies. Okay. Now, for reported profit or loss, now we go and we look at, and we'll take all of our loss segments, group them together, and then we'll take all of our profit and 0 segments, although I don't know that the exam ever has one that has a net income of 0. I guess it doesn't matter where you put it. So we put all of our what? All of our negative segments, all of our loss segments, add that number together, that big old negative number. Then we would go ahead and get all the positive, all those that had a positive net income, add them together, get that big old positive number. Whichever number is greater, we'll then multiply that by 10%. And any segment that then had a profit or loss that is greater than or equal to the absolute value of that number that we chose, whether it was negative or positive, would be a reportable segment. Okay. Now, that rule is a little bit harder to visualize. So what I'm going to ask you to do right now is to see multiple choice question, and I believe it's multiple choice question 50-55. But to see that, we need to get into the software, and I'm going to probably lose my camera, and that's okay if I lose the camera, because probably tired of seeing my face anyway. So if I lose the camera, that's okay. Hopefully I won't, but if I do, I do. Okay. But I want to put it in tablet mode is the reason I'm concerned I might lose my camera. But I want to go ahead and I want to take a look at well, it's not good if I lose my mouse and my whole computer decides to flip out on me. That's not good. Just because I went into tablet mode, the whole world's going to disappear on me here. That's annoying. Just a second, guys. I don't know if you can hear me or not. Okay. So what I want to do, can you hear me okay?
Yes, we can hear you.
Okay, good. Thank you. So what I want to do is I want to go look at
And I think I said 550, 55.
Yeah.
Okay. Okay, good. And you can see they have this Ajax Corporation reported the following. Some of these have a positive net income, some have a loss, right? And they want us to figure out which one would be as a reportable segment. Now, when you look, they give us the unconsolidated numbers, the consolidated numbers. We're going to focus on the unconsolidated numbers. That's how we do it. Now, what I want to do is just take you to the solution because it's a little easier. Our first job here is to figure out what is bigger, those that have a positive net income or those that have a loss. And it turns out that the income number is what is bigger. So we take that, we multiply that, and notice, guys, it is important that you know that the percentage amount for the threshold, and I had you flashcard that it's 10%. This problem didn't tell me it's 10%. When you're looking at the solution, it says 10%, but in the problem itself over here, it didn't call out 10%. So you have to know that, right? And then since 325,000 on an absolute basis, absolute value basis is bigger than 200,000, we multiply that 325,000 by 10%. That gives us the threshold. And then we look to what? We look to the unconsolidated amounts to see which ones have exceeded. So Astor has exceeded 32.5. BJax has not. Carter has, even though it's a negative number on an absolute value basis, it is larger than 32.5. Davis, yes. Elbow, no, right? It's only 20,000 and the absolute value is 32.5. Okay. Question.
Quick question is, if you use for one segment income, do you have to stick with that method for the other segment determinations, or can they make it by assets, et cetera?
It has to make it by any one of those. So if it makes it by revenue, reported profit or loss, or assets, it must be reported as a segment. It must be disclosed as a segment.
Okay.
Okay. Okay, good. Let's go ahead then and let's take a look at back to the text. Okay. And let's look at this, and I'm going to put myself back in tablet mode. And I am going to see if maybe if I plug the camera back in,
It will cooperate. Can you still hear me?
Yes.
Yeah, okay, so let me get back to full screen here. And let me see if I can start the video. Okay, good. Okay, now when you take a look at the 75% sufficiency test, and let's look at that. And they tell us that if the total of the consolidated revenue reported by the operating segment constitutes less than 75% of the consolidated revenue, additional operating segments need to be identified as reportable segments, even if they do not meet the 10% test, until at least 75% of the external consolidated revenue is included as a reportable segment. Okay. As a practical matter, though, you probably wouldn't want to have more than 10, because now you start to violate the understandability of the what you're trying to provide. You've now boggled the minds of the users with too much information. Okay, so when you look at that, and I look at it, what they're telling us here, they start saying, well, just keep adding segments however you want to, you get up to that 75%. When you start having kind of loose rules, that gets hard to test for the examiners. So I don't know that they'll ever have you adding segments. The only thing I can think of is maybe you have to add just one segment to take you over the 75%. And there's only one segment that will take you over that 75%. Even if you took all the others, it wouldn't bring you to 75. So you'd probably add that next one, I guess. But again, that gets really hard to write a good question on that, in my opinion. Okay, so to understand that rule a little bit better, we have our class question for this module. that we can look at, and that class question is multiple choice question 0127, I believe, and it is question 1 for this module. What module are we in? What module is this? Module
Module 4.
Oh,
number 4. Okay, good. So let's just go to that question. Okay, and let's go ahead and let's do it together. Okay, just because I want to show you that what you would do with that 75% rule. We don't need all this other stuff's a bunch of, something that's going to be beyond what we need to know to answer questions. If you see something in your homework that tests that stuff, just add a flashcard, guys. I don't want to sit here and read the book to you. Okay, but for the most part, it's the big chunks are what we flashcarded, highlighted in flashcards. So you look at this, and they give us information about the segments. They tell us they want us to use the revenue test. Notice, they do not tell you that the revenue test is a 10% test. That's why I asked you to flashcard that. Okay, so I guess it's 00127. I think I just put 0127. Okay, now you take a look, and you first look at the total revenue. You don't look at the consolidated revenue. You look at the total revenue is 83,000. You multiply that, and you had to know that. You had to have flashcard. It's a 10% test. You get 8,300. Okay. Now you go through and you look to see which of your segments exceeded that threshold, and you start to look, and on a total, when you look over here, LO did not, BIX didn't they? BIX is at 12. We're looking for those at 8,300. No for C, but DIL made it. DIL is 59. Okay. So now I'm interested, well, do I have enough? So since I have picked BIX and DIL, okay, now I go to the consolidated number because I have to represent consolidated revenue. And I pick that 8,000 plus the 43,000. Is that 51,000, guys? And then I divide that number by 60,000. 51,000 divided by 60,000 gives me what? Something like 80, what percent? 85%, something like that. Guys, I'm not here to talk to myself. Gives you 85%.
85%.
85.
Okay, good. So that 85%, okay, I only needed to get 75%, so I'm good. So the answer here is what? The answer here is BIX and DIL. Okay, and I think that's how most questions would go, where they're having you do the 10%. Unfortunately, you're gonna have to do that extra step to make sure you have enough segments. I think in most cases that will be the case, and they won't have you then going back and saying, okay, well, which segment should I add to bring me over the 75%? Because you could include 2, 1, and it starts to get hard to write a question that really does that. Okay. Okay, good. SEC requirements. Now, here's what we're going to do with this, because it's a lot of rules. It's a lot of, you got to disclose this, you got to provide that. This isn't audited, that is audited. And it starts to become such a bunch of sing-songy rules that what I'm going to have you do is flashcard these rules. We're going to go through this quickly, and I'm also going to tell you which multiple choice questions in your homework relate to what I'm asking in a flashcard. And so that's me telling you, just learn from the questions. Make the flashcards very quickly. Go to the questions. See how you answer the questions for this material. If there's something in the questions that I didn't highlight and index, just add a flashcard for it. I mean, I am of the opinion that the examiner shouldn't even be asking you this stuff. I mean, the person can look up what are the requirements as to what needs to be filed with the SEC. Why are they bothering us with this on the exam, where all of a sudden we have to know what goes into the 8K report? Come on, I don't have to sit there. Why do I have to memorize that? Okay, but they write the exam. They're entitled to have on their exam what they want, I guess. Okay, now If a company is, going public for the first time, they obviously have to register with the SEC. They file an S1 report. I don't think that that's really, I don't see any reference to the S1 report in any of this. What we're talking about is after you've gone public, what sort of periodic reporting do you have to provide? Okay. And when you look at 10K, that is filed annually. Okay. Now, when you see the word annual, okay, annual equals audited. A lot of the questions center around, well, what has to be audited, what doesn't? And what you're going to see is annual reports typically have to be audited, less than annual, not annual, typically not audited. Like quarterly reports are not audited, okay? Semi-annual reports are not audited. Now, when you come over, you take a look and they give us the filing deadlines, flashcard. I'm not even going to read that. Just flashcard it. I don't need to sit here and read to you. The bigger the company, the less time they have to file. Flashcard that. Okay. And then the statements have to be audited, as I've already said. Okay. So make sure you remember that. In fact, you can flashcard that the 10K has to be audited. And then I want you to write down the following questions: 09007, 06, and I don't know that you have to put the 0 in there anymore, so it may not accept the 0, but it'll accept those back numbers. But just in case, I'm going to write the 0 just in case you do need it. 07215, okay, and 05470. All of those questions ask you about the 10K. See how we're doing this? Kathy used to make some flashcards, but I'm also telling you what questions. Go to those questions, answer those questions about that so you can actually learn as you're looking at the material and making the flashcard on it, and then just have that in your flashcards so that just before your exam, you're looking and remembering this stupid thing that they're asking you to memorize about how much time entities have to file their 10K report. You can look that up. I don't know, an entity with the auditor or CPA would look that up. Okay. Now, if we're talking about Form 10Q, it is filed quarterly. If it's filed quarterly, it is what? It is not audited. However, it would be reviewed. And when you haven't taken the auditing class yet, or when you take it, or if you've had some exposure to this, you know, or you will know, or I'm telling you now, that a review is less in scope than an audit. And so they say, well, since you're going to audit the year-end statements, if you're a public company, we'll just make you review your quarterly submissions. Okay, so they tell us that the 10Q is to be filed quarterly. And here we go again with the amount of time that they allow entities to file these. And it's, something that you can flashcard, something that you can memorize. You should also flashcard that these statements are unaudited. Okay, but again, if it's not an annual statement, it's typically not audited. Okay, not annual equals not audited, but they are reviewed. Okay, so question that's relevant there is 08721. Okay, now when we come to these F forms, F equals foreign. F equals foreign. Okay, and if it's 40 F, that's the Canadians. If it's 20 F, that's everybody else. Okay, so go ahead and flashcard that F is for foreign and F 20 is for everyone other than the Canadians, I mean, F4 is for the Canadians, everyone else uses it. 20, their annual statements, so they are what? Audited, annual equals audited, okay? Now, foreign entities may also have to file semi-annual. If it's semi-annual, it's what? Not audited. Okay, so go ahead and flashcard that Form 6K is for foreign entities, and it is not audited. And I want you to put question 0678, ask you about the 6K, okay? 8K, Form 8K is for major corporate events such as asset acquisition or disposal, etc. Okay, flashcard, the kinds of things that go into Form 8K, and then that is going to be tested for you on, and that is, when I say tested, practiced in homework, 808999, and not 80, but 08, and then 08590. Okay, so again, when you come to this page, when you're making your flashcards, it's my suggestion, make the flashcards, go to the problems, and you'll be done with this stuff. Okay, now forms without letters, form numbers without letters do not equal financial statement information. So if they're asking you which of the following would not be in Form 3, 4, or 5, anything that lists a financial number, that's not the right answer. It's always what? It's always, more of names of entities, directors, owners, that sort of thing. Okay, so they're asking you what goes into Form 3, 4, 5, ignore anything that gives you a financial number. It's names, that sort of thing. Okay, and you can see that on 06077 and 06807. Okay, so I think for the SEC reporting part, I think that I pretty much indexed like almost every question. Okay, now if we talk about regulation SX, which is contained in the Code of Federal Regulations, which you don't need to know that, sets forth the form and content of any requirements for interim and annual financial statements that are filed with the SEC. Okay, and they provide key provisions below in case someone asks you about regulation SX flashcard, that's what it does. It tells us what we should be putting in form and content for our interim and annual financial statements to be filed with the SEC. There is a question that asks you, what does regulation SX, what's it all about? So go ahead and index the material to that question. Okay, and for the quarterly interim statements, they are to be reviewed. Okay, you can flashcard that. They are reviewed, but what? But not audited. Okay, and then we start talking about what interim information needs to be presented. Flashcard it, guys. I'm not going to read it to you. It's balance sheet for 3 corresponding in the quarter before and the quarter from the year before. There's not much benefit to me sitting here and reading that to you, but I do want you to flashcard it, and I do want you to put 6080 is a question to test that for the income statements. what needs to be provided, the quarterly statements from the previous period, all that. Okay, flashcard that. Okay, and then you come over and you take a look at statement of cash flow requirements, and you can flashcard that. Okay. Now, when we look and we talk about adjustments for fair presentation, okay, and use same accounting principles for annual and interim statements. Let me repeat that because that's a little bit sloppy. Okay, and you can flashcard that. Use same accounting principles for annual and interim statements. Okay, now the other flashcard I want for this discussion here about adjustments for fair presentation, because they don't mention it anywhere in the textbook here, but then there's a question on that. So I want you to go ahead and flashcard, okay? Take revenue in interim period. It is earned. So if revenue is earned in the first quarter, what quarterly statements would you include that revenue in?
Thank you.
Each quarter,
If a revenue is earned in the first quarter, what period would you take that revenue in?
First
quarter
period.
one,
In the first quarter. If it's earned in the second quarter, when would you take it?
Q2,
Huh?
quarter two,
Quarter two. Good. Okay, good. Flashcard. Okay, you can make it one flashcard. Allocate expenses that benefit more than one period. Allocate expenses that benefit more than one period. So let's say they say, well, they incurred an expense of 100,000, and that 100,000 will benefit the second and third quarters. So what should you do with that?
50,000 quarter.
50,000 in the second quarter, 50,000 in the third. Good. Okay. Okay, good. And then there's a question that kind of tests this up here that I just had you flashcard. Watch it wipe out the whole thing. Bastard. The question that is relevant is CPA 00237, and it's that stuff that just jumped off the screen. Okay. Question. Okay, good. Now we get to, this XBLR stuff now that, I mean, sometimes I think the examiners just can't seem to, help themselves with a lot of this stuff. But what XBRL does is it puts tags, data tags that reference right up here. Sorry, up here. Okay, it takes data tags to describe financial information. Okay, now what does that mean for us? I want you to flashcard that. That means the way they're going to show you questions on this, and you would see that in 06808. What they'll do is they'll say, well, which of the following would not be part of XBRL information? And the answer is what? Anything that's not financial in nature. If they're talking about assets, they're talking about liabilities, they're talking about revenues, that's part of the whole XBRL, because it's what? It's allowing you, what the idea behind XBRL is that it allows you to compare the, assets of different companies. And you can go through and do that sort of a sort where you can look at all the different assets of different companies. Maybe even done this in accounting research class. And the way they test it on the exam is they'll come out and they'll say, well, which of the following would not be part of the XBRL? Well, if it's any kind of financial reporting requirement, including footnotes, by the way, then yeah, it is. But if it's something like, the names of officers, well, that's not part of XBRL. It's actually stuff included in the financial statement part of the filings. Okay. Okay, good. So with all that, let's go ahead and let's take a look at a couple questions. Okay, guys, I think most of us had a chance to look at this. And again, when they're asking you what should be audited, what should not be audited, I did ask you to make a flashcard on that, okay? But, another way to look at this would be to say, well, which of these is a annual filing that has to be audited? So is the 10K annual?
Yes.
Okay, so that can't be right. That's got to be audited. How about S6K, I should say. That's what? That's
Semi-annual.
annual, that's semi-annual, so that does not have to be audited. These other two were what did have to be audited, so that's why they're not the right answer. And I just asked you to flashcard also whether it has to be audited or not. Do you see why I'm taking the approach here that I am with this? I mean, what do you want me to say? Okay, this is a requirement that I don't know why the examiners are doing this, to be honest with you, but you might get one or two questions. So let's just arm ourselves with some flashcards on this. Okay, okay, good. Let's go ahead. Let's take a look at this next one. Okay, guys, I'm not sure if everyone's had a good chance to do this, but looks like most of us haven't. It's just at some point it's kind of silly, but you can see, I guess I have to end the poll here. Share results. Can you see the results? Yeah, okay. All right, good. So most of us got this right. There were two ways to look at this question. I mean, one would be to just remember, okay, that we said what's on the Form 8K, but the other thing would be to realize that if it's quarterly results, we have a form for that. It's called what? 10Q stands for quarter. Okay. Okay, good. So make the flashcards and then see these questions, you know, in your homework. And I think you'll find that this stuff is annoying, but not terribly conceptually difficult. Okay, good. What I want to do is take the break right now. I know it's a little early for the break, but the reason I want to, if we feel we need to later, we can take another one. But I want to do it now. I'm showing 6:07. So I'm going to reconvene us at 6:20. I'll give you a little extra time because I want to remind you. Sorry, guys, I'm just annoyed that things close on me for no reason. I'll close that. And it opened, decides to close for some reason because I flipped my computer into tablet mode, I guess. I want you to take a look and grab chapter 2 right here, this cash to accrual information, and then we will get into chapter 3 after the break as well. But this flashcard, go ahead and open that up so you have it available, because when we're looking at some questions here later, it'll be useful to be able to kind of look at the flashcard. Eventually, obviously, I want you to memorize that and then use that to answer all the questions here that some students struggle with in this area. But I think that if you practice with applying the flashcard to those problems, you should be in good shape to answer. And that's an area that's probably going to be more in the 10-point range for you on the exam. Of all the other things in this chapter, they're like in the 2, 3, maybe 5 at the most point range, whereas this, turning cash statements into accrual and turning accrual statements into cash, that is something that the examiners recently have put more emphasis on. Okay. All right, guys. So let's go ahead. We'll reconvene at 6:20. Go ahead and download that, and I'll see you in a little while. Okay, guys, we are going to go ahead and jump back in to module 6 here, talking about, and they talk about special purpose financial statements. What's going on here? Sometimes, and it's generally not a very complex, very large entities that would do this, say a mom and pop grocery store, something like that. It may make sense for them just to prepare cash basis financial statements. Maybe they're going to go for a loan or something, and the bank says, well, look, you can prepare cash basis statements, and we are going to want you to get an auditor opinion on those cash basis statements, but you don't have to follow all the accrual rules, etc. Okay, so what we're looking at here is really the major focus at first is, well, what do you call a balance sheet that's prepared on the cash basis? Because the word balance sheet is reserved by GAAP for accrual financial statements. So we're going to see it's as simple as, well, you'd have to call it cash basis balance sheet. You can't just call it the balance sheet if you're using some basis other than accrual basis. Okay. The income statement, it can't be called income statement because we save that for accrual financial statements. So we'd have to say revenues and expenses arising from cash transactions or something. You can't call it the income statement because that's safe for the accrual. So we're going to go through and see what some of the basic rules are. And then where more of the emphasis is on the question of, well, how do you convert cash basis to accrual? How do you convert accrual to cash basis? That's the really point-rich area that we're going to focus on. And that's why I wanted to get that flashcard that helps you with that part. Okay. All right. So let's go ahead and take a look. And they call these other bases other than accrual, they call them an other comprehensive basis. It is non-GAAP, but it is widespread and has general understanding. For example, cash basis. So they give us that as an example. Cash basis could be tax basis. Maybe for whatever reason, an entity is going to prepare their financial statements based on tax law as opposed to based on the GAAP rules that we're studying for the large majority of our FAR exam, right? Regulatory basis of accounting. What happens here? Let's say you're an insurance company and you are regulated by the state commissioners. Insurance companies are regulated at the state level. And so there are various state insurance commissioners across several of the states, for example, California. And what happens is insurance companies have to file their financial statements or a set of financial statements with the insurance commissioner. When they file those statements, they have to follow the accounting standards promulgated by the National Association of Insurance Commissioners. And those rules say things, for example, like you can't capitalize as an asset office furniture because they want a more conservative look at an insurance company for their regulatory basis. So what happens? They go ahead, they file those statements with the insurance commissioner. By the way, you can go to their website, I'm sure, and take a look at any insurance company's financial reports you want from the Association of Insurance Commissioners website, but know that they're following different rules than the GAAP rules when you would look at that. Okay, so that's what's going on here. Okay, and we start looking at what the appropriate names are for the financial statements. Okay, and we have to use names that differentiate from the accrual basis. Okay, so what happens when we look, if we were talking about the balance sheet, we could not call it the balance sheet. Okay, we would have to call it something else, and we'll look at that here in a second. But we're going to see, we'll call it balance sheet, cash basis, income statement, cash basis, whatever. Okay. The required financial statements are equivalent, though, to the accrual basis balance sheet and income statement, even though you don't call it balance sheet, you don't call it income statement. The financial statement should explain changes in equity accounts. A statement of cash flows is not required, you do have to disclose that you are following an other comprehensive basis of accounting that is not accrual, that it is different than GAAP, a summary of what those policies are, and then of course you will have the informative disclosures that are similar to those that are required by GAAP. And we talked about those last time, you know, the summary of significant accounting policies and other footnotes that are required of GAAP. Yeah, you would put those even though you're following, say, a cash basis. Okay, so go ahead and flashcard those rules. And then let's go ahead and let's take a look. And they tell us that entities that are not required to use accrual basis of accounting may use cash or modified cash basis because they are simple to prepare and easy to understand. And you can go ahead and flashcard this because this almost sounds like a CPA exam question. That last part, cash basis financial statements are probably going to be used for less sophisticated entities. Okay, so you come over and they talk about under the cash basis of accounting, revenues are recognized when cash is received, expenses are recognized when cash is paid. So, you know, when I'm teaching introductory, I'm trying to beat that out of the mind of my students. No, it's not just because you receive cash doesn't mean you recognize revenues when you've earned the revenue, right? When the expense is incurred, you take the expense. Well, now we're saying, well, forget that for a set of cash basis statements, okay? And again, generally used by, you know, estates and trusts. I have a former student who's a controller at a trust, and she tells me, John, I can't remember my accrual accounting anymore because we use cash basis all the time, okay? Now, you come over and let's take a look, and we saw a statement of cash equity, and I want you to put down here that it is LIKE, the balance sheet, but you can't call it the balance sheet, right? Okay, so in pure cash basis statements, the only asset you have is cash, and the equity ties to the cash. Okay, when we are talking about the basically, it's like the income statement, but you don't call it the income statement. You'd have to call it the statement of cash receipts and cash expenditures or something like that. Okay, and you can see that again, the statement of cash receipts and disbursements includes the following. Okay, why don't you go ahead and flashcard the name? Statement of cash equity, that's like the balance sheet. And then the thing that's like the income statement is the statement of cash receipts and disbursements. And let's see what some of the rules are there. You take revenue when it's received. You will treat debt and equity proceeds as on the income statement, right? Because we don't carry debt, we show the cash coming in as though it were revenue. Okay, proceeds from the sale of assets, expenses paid. Debt payments don't pay down on a liability because we don't have any liability. We're only showing the cash. So that would be treated like a disbursement, like an expense, dividend payments, etc. All would hit the thing that's like the income statement. Okay, good. Now, you could have modified cash basis financial statements. Okay, and these modified cash statements will take what we've said about the cash and then start calling out certain type of accrual things. Okay. For example, common modifications include, you can go ahead and flashcard these, capitalizing and depreciating, for example, fixed assets, accrual not of everything, but of income taxes, recording liabilities for borrowing, capitalizing inventory, reporting investments at fair value. Okay. Now, what I want you to do is flashcard the names. Again, we saw the names that would be used for cash, for modified cash, and we could call it instead of a balance sheet. Okay, it's like the balance sheet. But instead of calling it the balance sheet, we'd have to call it something long-winded like a statement of assets and liabilities, modified cash basis. Okay. We would, or a statement of assets and liabilities arising from cash if we're using cash. Okay, a statement of revenues and expenses and retained earnings, or a statement of revenues collected and expenses paid. That's like the what? The income statement. Okay, so the main thing there, guys, is be careful. Don't use the GAAP titles. Okay, don't call it balance sheet. Don't call it income statement. It's got to be something that's more descriptive that calls out, hey, we're using cash or we're using modified cash basis. Okay, income tax basis. Okay, is another thing that we can use. If it's income tax basis, they're prepared using the methods and principles used to prepare a tax return. So things that you wouldn't take as an expense for GAAP purposes, maybe you would treat it as an expense for tax purposes because it's deductible, right? Okay. Presentation, again, guys, I know that it's starting to get, okay, John, we heard you. Don't use the GAAP titles. Okay, you've got to come up with something that calls it something other than the balance sheet, something in the income statement. Okay, question on any of that? Okay, good. Now, the big thing is the converting the cash to accrual and the accrual to cash. Okay, and balance sheet conversion, they don't ask a lot of questions about that. I want to focus on income statement conversion. Okay, and what we see with the income statement conversion questions. Okay, and again, this is where you'll get potentially, a bigger question, maybe a task-based simulation task or something. Okay, what they're going to do is they're going to give you one of three things. They're going to tell you, here's your net income, cash basis, turn it into accrual, or here's your net income accrual basis, turn it into cash, net income. They could do it where they'll say, here's your revenues, turn revenues from cash revenue to accrual revenue, or from accrual revenue to cash revenue, or they could say expense. Here's your accrual expense, turn it to cash expense. Here's your cash expense, turn it to accrual. Okay, so it's revenue, expenses. Often it's net income that they want to see that you can convert from one method to the other. Okay, so what I want you to do is look at and of course, I have to search for it to find it. Right here, because I can never find it on my taskbar. And what I have is the flashcards, okay, for how to go from cash to accrual, how to go from accrual to cash, okay? And so for both, you would start with whatever they're giving you, the net income. So for cash to accrual, they will give you the cash net income, okay? And then they'll give you certain information, and whatever it is they tell you for current assets, do the same, okay? So if they increase, then add the increase to net income. If your current assets decrease, then subtract the decrease from net income. So do the same. Okay, the key there is do the same. Okay, now for current liabilities, do the opposite. So they'll give you the net income, they'll give you information about assets, they'll give you information about liabilities. For the information they give you about liabilities, do the opposite. So if the liability increases, subtract the increase from net income. If the liability decreases, then add that decrease. Do the opposite. Okay, always subtract depreciation. Always subtract depreciation from the net income number that they give you. Always subtract that. Add fixed asset purchases, because in cash basis, we treat that as lower an expense. We know that for accrual, purchase of fixed assets is not an expense. So you would add that and then subtract any long-term borrowing. For a cash basis, they're treating borrowing like a revenue. For accrual basis, borrowing is not a revenue. Okay, so you'd follow those rules. If they're asking you to go from accrual to cash, okay, again, start with, in that case, they'd give you the accrual net income. For current assets, do the opposite. If the asset increases, subtract it. If it decreases, add it. For current liabilities, do the same. If the current liability increases, add it. If it decreases, subtract it. Always add depreciation, okay, to go from accrual to cash, because for net income under the accrual basis, you take that as an expense, so it reduces your net income. But for cash basis, depreciation isn't taken. It's not a cash expense, right? It's not, it doesn't have a cash outflow, so we don't treat it as an expense for cash basis. Subtract fixed asset purchases, because again, we're spending cash, and they treat that as though it's an expense for the cash basis, so we have to subtract it. Add the long-term borrowing. Okay, have this as a flashcard, practice, memorize this flashcard, and then practice it with the problems, and we're going to do that here in a couple seconds. Okay, now if the problem is just asking about revenue, because remember I said it could be income, it could be revenue, it could be expenses. If it's asking about revenue, no problem. Follow the same rules that we just set up here for net income, so you don't have to memorize a new set of rules. But I give you a little hint there. Usually they give you accounts that are related to revenue to deal with. Their accounts receivable, unearned revenue, and they give you information, of course, about what the cash revenue would be, or what the accrual revenue would be. And then you're going to have to sit there and follow the rules above to turn the revenue that's a cash revenue into accrual, the accrual revenue into cash. And if the problem is talking about expenses, then for expenses, you would reverse the rules. You would do the opposite of what I just gave you up there and reverse all those. And I didn't write those again, because you're simply doing the opposite of what you would have done had you been dealing with revenue or income. Okay. Now, I give you a reference to a question that's in the homework for that last thing about doing the opposite for expenses, but we'll get to that one a little bit later. What I want to do right now, and hopefully you've got that flashcard sitting there next to you now, so that you can go ahead and sort of see how you would have answered the question, the thing that we're going to look at. And it's also written for you here, okay? And then I'm going to go ahead and I'm going to look at, be nice if I could have both things side by side. Let's see if I can do that. There's that. And what do I want? Where's my textbook? I have everything here but the textbook. Okay, that might work. That might actually work. Let's see. Let's see if we can work that. Okay, so what I want to do is I want to go, and again, guys, I'm getting away from, they go through and they give you every imaginable different thing that you might have to deal with. And the way I like to do it is just the bigger rules. Okay. So in this question, this example, which is in your book, what is it page? What page are you guys seeing this on? 34? 34, okay. Okay, so in this question, what they did, and maybe I should just go over here for that first, is they tell me that they have a cash basis net income of 30,000. Okay. And they're sitting there and they give me certain information, okay, about the accounts receivable, the prepaid insurance, unearned service revenue, salaries payable. They're not calling them out as such, but these are what current assets and current liabilities, aren't they? Okay, so the rule that I gave you focuses on these. And then they're telling you that they also purchase a piece of equipment for $5,000 in cash. And they tell me that there's no salvage value on that equipment because I am going to need to do what? Depreciate that equipment. And I know I have to always, for whatever it is they're asking me to do, to go from accrual to cash or cash to accrual, I have to subtract. I always subtract the depreciation because I'm going from cash to accrual. So now with that information, you can kind of see the changes here. Okay, you can see the changes. And so what I did on what I wrote here on your flashcard, I don't know if I pull it over, we'll do it. Okay, good. So what I did here, I'm just not having a good way to do this. Maybe I can do it this way. I just want to see the changes. Okay, so I sat there and I took the net income. I started with the net income of 30,000, and then I just followed the rules as they appear on the flashcard. So my accounts receivable did what? My accounts receivable increased by 5,000. I'm not going to go over there, guys. You can probably look at your book and see it, that it tells us that the accounts receivable increased 5,000. So since it increased 5,000, since I have the flashcard memorized here, for current assets, I do the same. So since the accounts receivable increased, I add it. The prepaid, whatever it was, the prepaid account increased, so I add it. The unearned revenue decreased. Unearned revenue is a liability, right? And so for liabilities, I do the opposite. So since it decreased, I'm going to add it. My salaries payable increased. Since salaries payable is a liability, I do the opposite. I subtract it. I always subtract depreciation. Now, the $1,000 for the depreciation was what? They said it was 5,000. It said it had a 5-year life with no salvage value. That's 1,000 a year. So you always subtract the depreciation, and then you add the equipment purchase, and you come up with what? Accrual net income of 52,000. That's what they're telling us is the correct solution here back in the textbook to this question, is this 52,000. Okay, now I'm not going to do the same thing. I'm not going to repeat it for revenue and expenses, but you can follow those rules. And then what they did is they said, well, if this is the accrual net income, the accrual revenue and the accrual expenses, here's net income. But if the question gives you 30,000 of net income, and that's what it's asking you on a cash basis, then you would make the adjustments to the net income number, and you wouldn't have to separately do something for revenues and expenses. But you could practice with the revenue and expenses here and test out the rules the way I've given them to you. Okay, I'm not going to do that because it's just going to belabor a little bit. So now let's look at this question 1 and see, and don't feel bad right now. If you peek back at the rules that I have on the flashcard, that's okay. Right now, we're just trying to get a comfort level with what we're going to be memorizing and how we'll be applying it to questions. So if you have to look back at that flashcard now because you haven't had time to memorize it, that's fine. But apply those rules to answering questions of this nature, like this one that I have up on the screen right now.
Sorry, are we choosing?
Oh, I'm sorry. Sorry, guys. Yeah, let me put the poll up. Sorry. We're coming up on 2 minutes. I will give you 3 for this question. You should never take more than 3 minutes to answer a CPA question, but I'll go ahead and give you 3, or I will wait for everyone to have attempted it. Okay, looks like everyone's had a chance. That's 2:35. That is pretty good amount of time to take for a question like this. I would think that this one probably would be more than 2 minutes. That's good that you were in the 2:32 range here. And we got almost everyone got this right. So that's good. That's encouraging. And the fact that somebody chose D is also encouraging, even though it's not the right answer. It certainly is heading in the right direction. There was some ambiguity in this question that hopefully we wouldn't see on a CPA exam question. But let's go ahead and let's look at this one together, okay? And we can follow the rules for the flashcard. They're asking us, how can we turn this information about what? Now that number is what we're going to consider the the cash revenue, because they said that they collected 200,000. If they're following the cash basis, then what they collected would be their cash revenue. We start with cash revenue, and then we're going to make adjustments by analyzing current asset items. And typically with a question where they're asking about the cash revenue to turn to accrual or vice versa, they're asking you to analyze related accounts to cash revenue, which is what? Which is unearned revenue and accounts receivable. And so sure enough, that's what they do. They sit here and they tell us that at December 31st, year 1, Ward had accounts receivable of 40,000. At December 31st, year 2, it was 60,000. So it did what? It increased 20,000. And for current assets, am I supposed to do the opposite or the same?
The same.
Same.
Do the same, so I have to add it. Good. And then, and this was the ambiguity guy, they say unearned fees of 5,000. And it's like, well, unearned fees is a liability, it's an unearned revenue, but did it increase or decrease? And I'm assuming that since they're saying it was 5,000 and they don't give me a previous balance, I'm just going to have to go with, well, it must have increased. I mean, that to me is the most logical conclusion, but they should have been more careful to tell me that the unearned revenue increased. Okay. Now, I don't mind them being ambiguous about that if they hadn't put this as a choice, but that ambiguity, did it increase or decrease, isn't entirely clear to me, and that makes D, having D as a choice, unfair. But they meant it to be that what? The unearned revenue did what? It increased. So if the liability, unearned revenue increased, should I do the same or the opposite?
The opposite.
The opposite. So since it increased, I subtract it and I get this 215,000. Okay. Question. Okay. Turn you loose on another one. Again, guys, this is good practice. Okay. And I'm encouraged to see how well you're doing with these, because there will be a fair number of questions on this. And when I look, by the way, I don't recommend you join that Facebook group. I see such amateur advice on those things all the time that drives me nuts. But I see a lot of students on that thing saying, hey, I'm having trouble with the cash to accrual to cash questions. Okay, so I'm encouraged to see how well you're doing with these. So let's go ahead and let's relaunch the poll for this one. We're at 2:30. Okay, I'm going to go ahead and end the poll here. Looks like everyone's had a chance. Okay, a little more trouble with this one. We did pretty good. The reason I'm kind of going in my voice here with this one is because I thought this one was easier than the other question that we did pretty good on. The correct answer is A, but let's look at this together. And again, we're going to follow the rules. They want us to go from what? From accrual basis to what? Cash. So we got to follow that rule from accrual to cash. Okay. And the flashcard says start with the accrual net income. And so they tell us that the accrual net income here was what? 100,000. Write that down. That's the net income. So sometimes it's, important to make sure you realize, what am I doing here, right? Because it's easy to kind of get to the end of the question and forget what you're doing. But you're going from accrual net income, and you're going to try to turn it into what? I can put the word accrual over here. And you want to turn it into cash net income. Okay. And so what does the flashcard say? It says that for current assets, do the same. Okay. So I look, and my current asset did what? My receivable increased 10,000, didn't it? So, whoops. For accrual to cash, for current assets, I should do what? Do the opposite. So my accounts receivable increased. So since it increased, I do the opposite. I what? Subtract it. Is that what the flashcard says?
Yes.
Current assets, do the opposite. Okay. And then for current liabilities, what? Do the same. Since the liability decreased 6,000, okay, accounts payable decreased. And for liabilities, I'm going to do the same. So I'm going to subtract that 6,000. And that gives me the correct answer here, which is 84,000. Okay. So this is a situation, guys, where you've got to get used to this flashcard. Okay. You've got to memorize this. You got to practice with this till you get very, very good with these questions, because it will be a heavier area. Okay. Now, what I want to do is look at one more, because again, this is a heavy area, so I think it's worth us spending the time together. Hopefully I won't lose my camera. And what I want to do is go back to our homework and practice with one more, because we've seen what? We've seen one that does net income, cash to accrual, net income, accrual to cash. We've seen revenue. We haven't seen expense yet, right? So let's go ahead and practice with an expense one. And the question that I want to look at . Question I want to look at is 5631, which I had written down there as a reference of a question. Okay. And they sit here and they give me the whole thing on my screen here. They give me the that they mistakenly reported expenses on the cash basis, and they want to correct it to the accrual basis. So I'm sitting here and I'm saying, well, okay, I'm going from cash to accrual, and I'm going to turn the rules that are on this flashcard. I'm going to do now the opposite for expenses, right? I do the opposite of what is on the flashcard for expenses. If you want to make a separate expense flashcard, go ahead. That might be easier. I just didn't feel like typing it out because I know that I should just go ahead and reverse the rules if they're asking me about expenses. Okay, so they are telling me, and I'm just going to go ahead. I think it's best for me to just kind of co-op some space here, and we'll go back and forth between the problem in what we're writing down. So I should start with what? I should start with the cash expenses. Cash expenses are 35.2. I'm just going to write that in 35.2. That's my cash expense. The flashcard says that for revenue, I should do what? Current assets do the same. Current liabilities do the opposite. But since we're talking about expenses for current assets, I'm going to do the opposite. For current liabilities, I'm going to do the same. So now I come over and I look at the problem. And they make me figure out the difference. Okay, so my prepaid expenses are an asset, right? And the beginning is 13, the ending is 18. That's a difference of 5. And since it increased, what am I going to do? The same or the opposite?
Same.
Okay, no, for current assets for expenses, I reverse what we said for revenue. So for current assets to go from cash to accrual, for current assets, if we're talking about revenue or net income, I do the same. When we're talking about expenses, I should do the opposite, shouldn't I?
Yes.
Okay, so since it increased, I need to subtract it. So I should minus that 500. That's the increase in accounts receivable. And then for the liability, I have to look at the accrued expenses there in that problem. Right, and so they tell me for the accrued expenses, it was 1650, and it did what? It went down to 1200, so it changed what? 450. And since it's the liability, I should do the same. Okay, even though if it was revenue, I mean, I should do, yeah, I should do the same for the liabilities. Okay, so
No,
I mean, yeah, sorry, guys. It did what? It decreased.
it decreased the payable expenses.
It decreased, right? So since it decreased, I should do the same, right? So I should subtract it.
You need to add.
Decrease in account payable. So I should do the same. I do the opposite if it's revenue. If it's a liability, I do the same. So I should subtract it. 450. And when I do the math on that, I get would it help me if I had done the math on that? What's 35,200 minus 950?
$34,250.
Huh?
34,250.
34,250. Okay. So 34,250. Let me write that in. Hopefully that's one of the choices. $34,250. Okay. Again, I don't like all this. Just what's the difference and deal with that difference. If it increases, decreases. Again, if you're following the flashcard for expenses, you do the opposite of what the flashcard says, right? You don't follow the, I know it's confusing because I'm saying do the opposite, do the same. You do the opposite of the instructions, right? Question?
So I have a quick question regarding the flashcard. When it was an expense, it does the same for the current asset, but you said you would do the opposite for expense if it is cash to accrual basis.
I said do the reverse of what the rules say for expenses. So since I'm saying for cash to accrual, for current assets, do the same. That's if we're talking about net income or revenue. If we're talking about expenses, you would do the reverse of what I'm saying on the flashcard. So start with net income, that's the same. For current assets, I say do the same if it's net income or revenue, but if it's expenses, you should do the opposite. For current liabilities, the flashcard says do the opposite. That's if it's net income or revenue. But for expenses, you should do the same.
Okay, all right.
Yeah, okay. And like I said, if you want to make up a separate flashcard for expenses, if that's easier for you, go ahead. I just didn't feel like typing out another flashcard that talked about expenses, but you can do that. Just whatever rules I say for revenue and for net income, reverse them for expenses.
Okay, thank you.
Okay. Okay, I think that's a good coverage of that, guys. Obviously, you can see that there's going to be some, some muscle tissue you're going to have to build up around this, but I'm satisfied that with these tools here of these flashcards, you'll be in good shape for these. Okay. Okay, let's go back into tablet mode. See if everything's going to go to hell in a handbasket on us now. Okay. Not yet, anyway. Okay, good. All right. Now, let's take a look. I think that was all the questions there. Yeah. Ratio analysis. I am not going to cover ratio analysis with us together. One, we're already against it on time in terms of getting through the chapter material, and I wouldn't have done it anyway because what happens is it is simply a listing. It's the financial statements, the balance sheet, the income statement, and then a listing of ratios. And it doesn't really do us much good time here together for me to say current assets is current ratios, current assets divided by current liabilities. No kidding, I can see that. Okay, so what I want you to do though is look into your Becker flashcards and make sure that every ratio that is listed in the book is also in those flashcards. If there's one missing, add it. I need you to memorize every ratio. I need you to work the questions from this module, module 7 here. I need you to work the questions from this module, okay, including the task-based simulation. This, I'm thinking, is probably a 5-point area, but if they slap you with a task-based simulation on ratios, then it becomes a 10-point. So I don't think you need to watch the recording, but I do think I absolutely want you to memorize all the flashcards for all the ratio. Again, if there is a ratio that's listed in module 7 that you don't have a flashcard already made for you in Becker, make those flashcards and then go ahead and practice with the problems with them. I don't see much benefit to me sitting here and reading out ratios to you, marking out ratios to you. Okay. Okay, good. Come over then. And let's jump to the next module here for chapter 2, which is partnerships. Okay. Now, for whatever reason, and this is why I don't like that Facebook Becker group, is weird rumors get started on there and there's no basis for them. For example, that partnerships is no longer on the exam. That is not true. That's why it's in the book. It's still on the exam, okay? And we're going to have to be able to handle that. Now, the good news about partnerships is it is a limited amount of some limited techniques that they're going to use to admit a partner or to dismiss a partner, to disperse to a partner, to exit a partner. We're going to see that it's going to be either the exact method, the bonus method, or the goodwill method in order to add the partner. When you exit a partner, it's either the goodwill method or the bonus method that they ask us about to exit a partner. And then there's also how to distribute amounts to partners, which is simply a reading comprehension exercise, because in a partnership, what would happen is that, you know, if you were to go to court against your partner, the judge would say, well, let me see the partnership agreement, and they would apply whatever the partnership agreement says. Well, that's what you're doing when you are distributing money to partners. You're following whatever the problem tells you was the agreement. Okay, so that's what we're doing here, and that's where we're going with this, and we're going to take a look at some of this. Okay, and let's go ahead and let's take a look at admission of the partner. Okay, and the first thing we want to do when we're going to admit the partner is under what method are we going to admit the partner? And it's either going to be the exact method, the bonus method, or the goodwill method. Okay, now beneficial passkey. Finally, the beneficial passkey that we're going to flashcard. You'll know that you're supposed to use the exact method if the question, and it says we'll always ask how much should the new partner contribute in order to have an X% interest. Okay, and there will be no reference to goodwill or bonus. So sometimes students will say, well, how am I supposed to know I'm supposed to use the exact method? It didn't say exact, because it asks you what? It asks you how much should the new partner contribute, and there'll be no mention of bonus or goodwill method. Okay, so let's just take a look at this. And really, guys, when I look at these, I'm like, okay, this is sounding like, you know, my introductory to algebra class here. Okay, they tell me that we have A, B, C are partners in a 3-person partnership. They have capital accounts of 20, 30, and 50 respectively. A, B, and C decide to admit D as new partner with a 25% interest. Okay, so what happens? Partner A is 20, partner B has 30, partner C, and we want to know, okay, what does D have to contribute to get the 25% interest? And we know that this is the exact method. So we go ahead and we sort of set up the algebra here. So D, you add these three together, that's the 100,000. And then D is going to get 25% of whatever that new equity is. Okay, and that will give us the total new equity. So then what? Then they go ahead and they subtract 0.25, and this is the algebra part, from each side. And so that means that what? 100,000 equals, if the total new equity, of course, is 100%, and you subtract 0.25, you're left with what? 0.75? You divide each side by 0.75. And when you do, the total new equity is 133,000. And to get 25% of that, then D is going to have to contribute 33,000. 333. Kind of fun. Not too bad. Question? Okay, good. Now, if it's the bonus method, and we'll see later if it's the goodwill method, they're going to tell you how much the new partner is contributing. And you're going to have to figure, and then if that's the case, they're going to have to tell you whether they want to use bonus or goodwill, or they may say they decided not to recognize goodwill, which means can't be exact because they're not asking me how much they have to contribute. They're telling me no goodwill, so I'm left with the bonus, or they'll just say use the bonus method. Okay. Now, what happens? Generally, the bonus is paid to the existing partners when they admit. Remember, we're talking about admitting a new partner. And when they admit the new partner, they will basically share that bonus in whatever it tells you their profit sharing ratios are. So let's just look at that and write out. They tell us, okay, here's their profit sharing ratios, 60-40, okay? So A gets 60%, B gets 40% of whatever the bonus turns out to be, okay? And they tell us what their capital accounts are, respectively, and they tell us that C has agreed to invest $35,000 for a 1/3 interest in the new ABC partnership. Since the partnership has decided not to recognize goodwill, the total capital of the resulting partnership is $75,000, which is the 30 plus the 10 plus the 35 that the new guy is bringing in. Now, at the rest of what they're giving you here, guys, is the solution. In the CPA exam, they're going to give you that first part, and then they're going to ask you what the rest of this thing is telling you. But I'm just going to go ahead and I'm going to take what's up here and pretend like I'm on the exam, and I'm sitting here and I'm saying, okay, I've got what? I've got 30,000. That's my partner A, I guess. Okay. I've got partner B. B has what? Has 10,000. And they tell me that the new guy, I guess they're calling him C, is coming in with 35,000. So I add that up. That is what? 75,000, like they told me here. And they may not even put that, the total capital of the resulting is 75,000. That may not even be in there. They may, just tell me that first part. Then I got to add those up to 75,000. Since they're telling me that that's a what? 1/3 interest that he's getting up in the problem information, I multiply that by 1/3. So he's going to get what? 25,000. How much is he paying though? He's paying 35,000 to acquire a 1/3 interest that's only worth 25,000. So that's a $10,000 bonus. Now, sometimes we'll look at one in the homework in the class question here in a minute. They'll just stop there and they'll say, okay, you got the bonus. Other times they may ask you, well, what should go to A? What should go to B? And that's easy enough. You simply do what? Multiply it by their respective profit sharing ratio. Sometimes they may say to you, well, what should be in A's capital account at the end of this? Well, if that asks me that, A started with what? With 30, right? Just looking at A's capital account, we just added what? 6. So in that case, the answer would be 36,000. Okay, not too bad. Now, sometimes, question on that? Sometimes, huh? I'm hearing murmurings of some sort. Okay. Sometimes, maybe the bonus goes to the new partner, and sometimes students will be, well, why would they give the new partner a bonus? Well, look, maybe this person's bringing in some knowledge and they're trying to increase their, level of services that they can provide. CPA firm, maybe this person has some, special data analytics expertise that they have developed because they got their master's science and accounting and data analytics, right? Okay. So what happens? It is possible for the existing partners to give a bonus to the new partner. Okay. So now they're telling us that C invests what? Invest 14,000. Well, for a 1/3 interest. Okay. So now C is the one that's receiving the bonus. And I'm going to put that in green because now they're giving me the answer. Okay. From A and B, because the 1/3 interest is what? The 30 plus the 10 plus the 14, 1/3 of that. What's 30 plus 10 plus 14? Let's go ahead and do the math on that. Oh, it's right here. 30 plus 10 plus 14 gives me 54 times 1/3 means that what? This person's getting 18,000, but they're only paying what? 14,000 for that. So they're the ones getting the bonus here. So that bonus got to come from somewhere. It comes out of A and B respective to their profit sharing ratios. And again, they may ask you, what's the bonus? The 4,000. They may ask you what's going to end up in C's capital account, A's capital account, B's capital account. That's typically how they have, ask these questions. Okay, now goodwill method. Okay, and I like the goodwill method because in the goodwill method, everybody wins. Okay, nothing comes out of anybody's account. Everybody goes up. Okay, so what happens? You come over, and when it's goodwill, and again, they'd either have to tell you not bonus, or they tell you the amount that the new partner is bringing in. That means it's not exact, and then they have to tell you use bonus, or they'll tell you use goodwill, or they may say don't recognize goodwill, which means you're left with bonus. But here they said goodwill. Okay, now what happens in here? Now C, the new partner, is bringing in 35,000 for a 1/3 interest. So under the goodwill method, I say, well, if this cat's paying 35,000 for a 1/3 interest, the company must be worth 105. The only capital that's been invested is what A and B had to start the problem, plus with 35 that the new guy C is bringing in. That's only 75. So there must be goodwill of 30,000. And that goodwill will be attributed to all the hard work that A and B have done so that this guy is willing to pay 35,000 for this 1/3 interest. And so we write that goodwill up to their accounts. So everybody goes up, and C ends up getting an amount for whatever it is they contributed. Okay. All right, good. Let's look at a couple multiple choice questions. Okay, guys, I'm gonna go ahead and end the poll. It's about 2 minutes, and it really shouldn't take you longer than 2 minutes to answer this question. So I'm gonna end the poll, and looks like most of us, although a couple of us didn't participate, but most of us that participated got this right. Okay, so that's great. All right, so let's just look at this though. You know, I'm not a huge fan of see what the question's looking for, but for these questions, you know, you start seeing the word bonus in there, and you start seeing that they're telling you, you know, what the new person is investing, and you're like, okay, I got a partnership problem, and I'm going to have to figure out the bonus. Okay, so you know that it's not the exact method and it's not goodwill, right? So then I say, well, 45,000 for one partner, 25,000 for the other. New guys coming in at what? 30,000. Now I go ahead and I write that 30,000 down because I know that that's going to be relevant to calculating what the bonus is, right? And they tell us, you know, that that's going to yield 25% of the new partnership. So I add that together. That gives me what, 100,000? I'm doing my math right? Okay. 100,000 times 0.25 only has a value of what? 25,000, because the dude's getting 25%. If I contribute 30,000, that means that what? The old partners are going to get a bonus of 5,000. I mean, you could literally start to do these questions just like this, just as fast as I just did that one, as you get more comfortable with them. Okay. Okay, good. Let's try another one. Same fact pattern, guys, but now it's goodwill. Okay, guys, we're coming up on 2 minutes, so I'm going to go ahead and end the poll. I think that a question like this could easily be answered, you know, maybe in a minute or so. Oops. Okay, you don't have to re-answer it. Most of us got it right. Sorry, I think I ended the poll and then ended the results. You don't have to re-answer it. Most of you got it right, okay, which was choice D. So let's just go ahead and see how we would come up with that. Apologies, I didn't leave the results up very long, but most of us got it right. But let's look at it, okay? So what happens? We have, and they're telling us there's an investment of 30,000. They're saying, hey, recognize goodwill. So I know I've got to use the goodwill method, 45 plus 25 plus 30. You know from the previous problem, right? Same numbers, that constitutes 100,000. And they're telling us that for 30,000, this guy is going to get 25%. So if I'm sitting here and I'm saying that for 30,000, that's going to give him 25% of the new value, okay, the new value of the equity, then I simply take the 30,000, the way I like to do it. I divide each side by 0.25. That means that the new value is what, 120,000? Meanwhile, there's only 100,000 that's been invested. Well, that intangible asset, that cloud, is not what's been contributed. It's something that's floating around the air. And we call that what? Goodwill of 20,000. Question. Okay. Okay, good. Profit and loss distribution, follow directions. Okay, it's in accordance with the agreement. There's nothing else to say. When there's a partnership and you're distributing profits and losses and whatnot, the courts look to, well, what does the agreement say? Okay, so let's just go ahead and let's take a look at an example of a problem and see if we can read through and see, you know, our reading comprehension is such that we understand what to do. So they tell us that ABC co-partners had a capital balances at the end of the year, but before profit distribution of 30, 60, and 90. The partnership profit for the year, excluding any payments to partners, was 200,000. The partnership agreement provided for interest of 8% on ending capital balances, a salary balance of 10, a salary to A of 10,000, and a bonus to C of 15% of partnership before any distribution to the partners. Then anything that's left will go what, 20% to A, 30% to B, and 50% to C. So we just start following the directions. There was profit of 200,000. We've got the guaranteed bonus to C. That's got to go to C, that 30,000. So that's going to go into their account. Then what? Then we've got 8% of whatever the capital balances are. So for example, I'm not going to do all three of them, but for B, B has what? B has 60,000. Okay, so 60,000 times the 8% means that B is going to get 4,800. I'm not going to do all three of them, guys. You kind of get it, right? They have 60. They're supposed to get 8% of that. So that gives them 48. And then we got to pay the salary to A. The salary to A is 10,000. That, of course, obviously goes to A. And so now we're left with this 145,600, and we distribute that based on their, you know, profit sharing ratio. So if you're taking that 145,000, and again, I'm not going to do all three of them, 145,600 times what? Times 0.5, half of that goes to what? Goes to partner C. That's that 72.8. We do the same for the other two. And the question, they probably wouldn't ask you all three. They'll probably say, you know, how much goes to, and they'll choose one of the partners. Okay. Follow directions on those. Let's try that. A lot of these partnership questions, guys, are really a question. Well, you have to know when to use the bonus method and stuff, but then they start to almost become a reading comprehension exercise. So let's just go ahead and let's try this one. Okay, we're about 2 minutes into this. I'm not seeing full participation here, but let's go ahead and end the poll and share the results here. And most of us got this right, although there was like maybe 3 or 4 of us that didn't work this one. But I'm going to go ahead and stop sharing. The poll A is the correct answer. Okay, but let's look at this one. And we've got Young. We've got Zinc. And they want us to tell us what's in Zeke's account. Okay. Now, the way I would do this is I would just do them both. Okay. As I go along, because it's you gotta kind of follow the instructions, right? So if Young has 160,000, respectively means that what the person they say first gets the first amount. Okay, and the person that they say second gets the second amount. Okay, so that's what they had. And then it says the partner received a 10% interest on average capital balances. So if you take that 10%, that means you got to what? You've got to give 16,000 to Young and 10,000 to Zinc. They tell us that what the profit before the interest distribution is 4,000. So 4,000 minus what? Minus 26,000 that has been distributed means that we have a 22,000 loss now that has to go, and they tell us that it goes what? It's divided equally. So that means that half of that 11,000 going to go against Young and 11,000 going to go against Zinc's capital. So they didn't ask us Young. They could have. Young would end up with 5 and Zinc would end up with a negative 1,000. The answer to this question.
Professor, I was just curious
$1,000 decrease. Yeah.
Just curious about the word interest. What are they referring to? Is this a shareholder loan? Is this more?
No, that's not the best wording, Eric. I'm glad you mentioned that because when I read that, I'm like, well, they make it sound like interest, like an interest rate or something. They mean before their respective interest distributions. Okay, because they say they receive a 10% interest on their average capital balances. So they get 10% interest on whatever their balances were. It's just a term for the percent that you should apply to their balances. It's not like interest on a loan or anything.
I mean, is this functioning as a dividend or what is that 10%?
It's the interest that they get on their balances. I don't know what you want me to tell you. They get a distribution to their capital accounts of whatever of 10% onto whatever it is in their balances, in their average capital balances. I mean, yeah, it sounds like you want me to invent something that's other than what's in the problem. Okay, so I don't know what you're asking me, so I would just accept the problem for what it says. Okay, all right, good. Let's go ahead and let's look at withdrawal of a partner. Now, with this one, what I find interesting in this discussion is that they don't put any numbers on this, and so it's harder to follow. Okay. But they say the difference between the balance of a withdrawing partner and the amount the person is paid is the amount of bonus. Okay. And the bonus is allocated amongst the remaining partners. Okay. They're the ones that are going to pay out the bonus. So, you know, they tell us that there's an asset adjustment. Okay, now I don't like examples with no numbers, just X's. So I'm going to assume that the assets fair market value is $100,000 greater than the book value. Okay, so we're going to write the assets up $100,000. Okay, so I guess the fair market value would, a better way to write that would be fair market value equals, and it equals $100,000 more than the book value. Really, at this point in the discussion, it's going to start this nonsense. Okay, so it's greater than the book value. Okay, so I have to write the assets up. Now, in this, because they didn't give us numbers, so I'm just, sometimes students say, where did you get these numbers? I dreamt them up. 40% of the capital is to A, 40% is to B, and that leaves, of course, 20% that is to this partner X, which is the one that's going to be leaving. Okay. And so when we write up the assets, we have to debit the assets for 100,000. And then we credit everybody for their respective amount of that 100,000, 40,000, 40,000, and 20,000. Now, in this problem, I just am saying that partner X started with 30,000. Again, a number I made up. But then we just credited them for 20, didn't we? So that means the balance here now is what, 50,000 for partner X? Okay. Now, I am assuming that they want to pay a bonus. Okay. And the bonus equals 10,000. They're paying this guy a bonus as he's leaving. It equals 10,000. So what's happening? They're paying him a bonus of 10. The bonus equals 10. How much does he have in the capital account? 50. They're paying him a bonus of 10. Again, I'm just making all these numbers up. So that means that they got to cut him a check for how much? For 60,000 to withdraw him out, pick him out of the partnership, whatever, and leave him with an extra 10. So I know they have to do what? They have to credit the cash for 60. That'll cash him out of the 50. Plus he gets an extra 10. That's the bonus. So that will get rid of partner X's capital. And that's appropriate since he's leaving. And then of that 10,000 bonus, 40% of, now we're left with this sort of what was left. It was 80%. So 40% divided by 80% is what? Is 1/2. So 5,000 would be paid to buy partner A, would come out of their capital account. And again, the 40% divided by what is now the remaining, what, 80% of those 40% share, half of that would come out of B. Okay. Question?
I'm a little lost here. Why is it an asset adjustment, the 100,000?
Because if you're kicking out, if you're adding a partner or you're moving an old partner out, it's seen as a new entity. And so if it's a new entity, you get to revalue the assets.
So this is assuming no liabilities. We just have the assets in the capital, right?
Well, if there were liability adjustments, then which is not common, but if there were liability adjustments, then I guess you'd have a net asset adjustment that you would make
Yeah.
up, could go up or down, but most of the time, what you'll see in questions is they're saying, well, the assets have a value that's greater than their current book value. You distribute that first, then you go and you liquidate. Okay. Okay, good. Now you come over, and if it's the goodwill method, okay, again, the asset adjustment would be the same thing. I'm not going to change that. Debit that 100,000. I'm just keeping the same facts I made up. So 40,000 again would go to this guy, 40,000 to this guy, and 20,000 there. Okay. And again, I'm assuming that X capital started at 50,000. Huh? What am I doing here? I'm not started at 50, excuse me, guys. Started at 30. Same thing I said up here. And we just added 20. So that brings the balance to 50. I'll just write the balance over here since I've squeezed myself into the balance is 50, right? Okay. Do it that way, I guess. Come on, John. Screw you and your lousy eraser. Oh, now it's going to play games with me and be stuck on eraser. I'm glad we're almost done because the computer's starting to mess with me. Okay, started with 30, added 20. What's the balance?
50.
Balance is 50. Okay, and we're saying that 50,000, okay, represents what? Represents 20% of the company. So the company has a value of what? 250,000 if you do the algebra on that, right? But if they're going to pay the dude a $10,000 bonus, okay, they're going to pay him off 10,000, then that would get added to his account. So his account would then be worth what? 60,000. And if you're saying, well, 60,000 represents 20%, then you're saying the company is worth what? 120,000. Well, if I wrote 10,000, I meant to write 100,000. Well, if before you pay him this extra 10, it's worth 100, and then when you pay him the extra 10, we're saying it's worth 120. Then the difference between the 120,000 and the 100,000 is $20,000. So if that's $20,000, wait a minute, am I doing this right? Not 100,000. I don't know where I got that number. Sorry, guys. 250,000. If you do this math, I don't know where I got it. If you divide, that's 250. That's correct. If you divide 60 by 20,000, it's not 120,000. It's how much? 300,000. So that difference between the 300,000 and the 250,000 means that you're saying there must be goodwill here of 50,000 because we're willing to give this guy $60,000 to cash out an interest of 50,000, right? So you go ahead and you record the goodwill of 50,000. All right. The capital account is going to be cashed out of this guy in a second, but you got to give him what? If the goodwill's 50 and he's a 20% owner, the 50,000 of goodwill times 0.2 gives him 10,000. So we just added 10,000 to his, so that brings his account to 60. The 40%, not 40,000, but the 40% of the goodwill of 50,000, that means that 40,000, excuse me, 20,000 goes to this guy, and 40% of the 50,000 or 20,000 goes to this guy. Okay, so we've gone ahead and we've distributed the goodwill, and now we can go ahead and cash him out. We're cashing him out for 60,000. So we debit his capital account, that closes him out, and we credit the cash for 60,000 because that's the money that we're giving him. Okay, so again, so got a little stuck there. Just to review, if you didn't pay him an extra 10,000, you'd be saying the company's worth 250. But since you're going to pay him an extra 10,000, you're going to give him 60. You're saying the company's really worth what? 300. That difference is goodwill. You distribute the goodwill based on their profit sharing ratios. When you give that extra 10,000 over here to the exiting partner, that brings his account up to 60, and now we can go ahead and cash him out. Okay, so I don't know about you, but if there were no numbers, this thing would not make any sense at all. So that's why I put some numbers on it. Question. Okay, liquidation of a partnership. You know, again, it is a following directions thing, but commonly creditors, including partners who are creditors and non-partners who are creditors, get their money first. And then if something's left, then it will go to the partners as you're liquidating the entire partnership. In other words, you're giving them cash. Since you're giving them cash, you'll have to convert any non-cash assets like, fixed assets or whatever. You'd have to convert those to cash. Okay. Now you go over and you start to, and again, it's follow directions. Okay. And they give us different scenarios that we will use to follow the directions here to distribute these things. Okay, and we have these ABC, and you can see their respective percentages. But let's just go over to the worksheet because they have the percentages there, okay, of who gets what. And what we have is 75,000. The problem told us of non-cash assets. Our first job is to turn those into cash. And so since they sold them for 145,000, that means that 145,000 now is going to be distributed to the partners. But we have to do what? We have to first pay the liabilities, and the problem told us that there were liabilities of 25,000. So that's you got to pay those people off. They're not part of this deal. And then you're left with 120, but there was 15,000 that was supposed to go over to sorry guys, I missed something. If we sold the assets for 125 and they had a value of 75,000, that's what? That's a 50,000 gain on that. And I first have to distribute that to the partners. I forgot to mention that. So I have to distribute that. So 50% will go to A and so on. Okay. And then the remaining 30 and 30% of 50 30 is 15 and 20% is 10. So you distribute that. Then you start paying off the outside creditors. Then you got to pay the partner that loaned some money. And by the time you pay that 15 and you pay that 20, that 15 and that 5, excuse me, because that partner's got to be paid their 5, you're down to 100,000. And the 100,000, you go ahead and you simply distribute that according to what the requirements were of the problem. And so you go ahead and you give 35,000 to A, 35,000 to B, and 30,000 to C, because that's what they're left with after you've gone through and, allocated everything across. Okay, I'm not going to do the other, what if it sells for this, what if it sells for a loss, etc. You can look at those on your own. I think what you're seeing is that, you just follow the directions, whatever they are. Okay. Okay, that is chapter 2. I think we're chasing a 1 chapter deficiency dragon here that we're going to have to continue to just sort of work our way through as we move along. So I'm going to adjourn class now. It's almost 8 o'clock, and we will pick up with chapter 3 next time. Okay, guys, any question?
Thank you.
All right, see you next time.
Thank you. Bye.
Thank you.
Thank you. Have a good night.
Bye-bye.